Imagine two £100 notes arriving in Britain on the same morning. The first appears at the top of an employee's payslip. Before the worker can touch it, a machine swings into action. Income tax is removed, national insurance is removed, the figures are sent to HMRC, and only what remains reaches the worker's bank account. The second note lands in a company bank account. Nobody takes tax from it immediately. Instead, it enters a maze filled with doors marked wages, rent, equipment, expenses, dividends, pensions, other companies, and eventually offshore. By the time the worker is deciding what to buy with what is left, the company's money is still deciding what kind of money it is. That is the hidden difference at the centre of the British tax system. Tax is easiest to collect when money is simple, visible, and unable to move. The more choices attached to it, the harder the final bill becomes to calculate. So let us follow both notes. For the employee, the journey is almost over before it begins. Most workers pay through pay-as-you-earn, or PAYE. The employer calculates the deductions, removes them from the wage, and reports the payment to HMRC on or before payday. The worker can check the numbers, but they never receive the full salary first and decide what should count as taxable later. Picture a conveyor belt. Your gross wage enters at one end. It passes under a large HMRC stamp, drops some coins through a trapdoor, and reaches you at the other end as net pay. This system is extremely effective. HMRC estimates that the gap between the PAYE tax that should be collected and the amount actually collected is only around 1%. When the tax is taken before the money reaches you, there are very few places for it to hide. Now follow the other note into a small limited company. Suppose a business sells something for £100. That does not mean it has made £100 of profit. It may have spent £30 on materials, £20 on staff, £10 on rent, and £5 on software. After those real costs, only £35 is left as profit. Taxing the full £100 would make no sense, because much of it was the cost of making the sale. This is why businesses deduct genuine running costs before taxable profit is worked out. So far, nothing strange has happened. The business has not found a loophole. It has simply paid for the things it needs. But now we reach the first fork in the maze. An employee mainly receives one type of reward, salary. The company owner can control several routes. The company might pay them a salary. It might pay a dividend from profits. It might put money into their pension. It might buy equipment for the business. It might keep the profit inside the company to fund next year's work. Each door has different rules, and each one can change when tax is paid, which tax is paid, and who pays it. This does not mean the owner can call their weekly food shop a business expense or put a family holiday through the company. Personal spending is still personal spending. Dividends must come from available profits. Salaries go through payroll, and money borrowed by a director has separate rules. The advantage is not a magical tax-free wallet. The advantage is choice. Imagine the worker standing in front of one gate marked PAYE. Beside them, the owner stands in a corridor with several legal doors. None guarantees no tax, but choosing the route and timing can change the bill. A company may need a new machine, computer or van. Buying it can qualify for tax relief because the money has been reinvested in the business. An allowable employer pension contribution can reduce taxable profit while moving money into retirement savings. The owner may also leave profit inside the company instead of taking everything immediately. In the right circumstances, real costs, investment and reliefs can reduce a company's taxable profit to very little or even zero for that year. But the owner has not necessarily received all that money as tax-free cash. Some became equipment, some went into a pension, some stayed inside the company. The bill fell because the money was used, redirected or delayed in ways the rules allow. For an employee, many choices happen after tax. They buy a computer from net pay, they save from net pay, they pay household costs from net pay. The company often makes its choices before profit is taxed. That difference becomes much more powerful when one company grows into a group. Picture a successful British business as a large bucket collecting money from customers. At first, the profit sits neatly inside it, then pipes are attached. One pipe leads to another company that owns the brand name. The British company pays it a royalty for using the brand. Another pipe leads to a company that provided a loan, so interest flows out. Another leads to a head office charging for services. Each payment can reduce the profit left in the British company. These payments are not automatically fake. The company that owns valuable software, lends money, or provides real services should be paid. The difficult question is how much. When unrelated companies trade, they negotiate against each other. Companies in the same group are controlled by the same owners, so they can set prices between themselves. The law says those prices should match what independent companies would have agreed. This is known as the arm's length principle. That sounds simple, until the thing being priced is not a box of screws, but a famous brand, an algorithm, or a customer database. There may be no clear price tag. One team of experts may value it at £10 million, while another argues it is worth £50 million. Your payslip is a calculation. Their tax bill can become a debate. Now attach the final pipe and run it across the sea. The company receiving the royalty or interest may sit in another country, perhaps one with lower taxes. The British company shows less profit because it paid the charge, while more profit appears in the overseas company that received it. This is the basic idea behind profit shifting. The sale may happen in Britain, and the customers may live in Britain, but part of the profit is linked to an asset, loan, or company somewhere else. Depending on the facts, legal deductions, reliefs, and overseas activities can reduce a particular company's UK corporation tax bill dramatically, sometimes to little or nothing. But opening a bank account on a sunny island does not make UK tax disappear. UK residents normally pay UK tax on worldwide income, and many countries automatically share financial account information with HMRC. A foreign company can also be treated as UK tax resident when its real central management and control is in the UK. There are also rules to check prices between connected companies and rules aimed at certain foreign companies controlled by UK residents. In other words, the overseas pipe exists, but HMRC knows where many of the common exits are. The structures that survive are usually more solid than the cartoon version. They may involve real offices, real employees, real contracts and assets genuinely owned overseas. Once a business operates across several countries, the argument becomes, which company created the value, owned the risk, funded the work and controlled the asset? That is how a simple £100 sale turns into a map covered in arrows. There is also a twist. The largest share of Britain's estimated tax gap is not attributed to giant offshore corporations. HMRC says small businesses make up around 62% of the overall gap, while large businesses account for around 12%. The corporation tax gap is much larger than the pay-as-you-earn gap, but it includes mistakes, unpaid bills, hidden income, evasion and disagreements over the rules, not only legal tax avoidance. The real dividing line is not honest workers on one side and dishonest owners on the other. Most business owners are not hiding money offshore, and many have less security than employees. The dividing line is between money trapped on a straight track and money able to enter a maze. A wage has a name, a date, and an employer attached to it. HMRC can see it and collect from it before the worker is paid. Business income must first be separated from costs. Company profit can be reinvested, retained or paid out in different ways. International profit can be split between companies, countries and assets that are difficult to price. Every extra choice creates another place where the bill can change. That is why your tax is easy to collect, and theirs is not. Your money reaches the tax collector before it reaches you. Their money can pass through accountants, companies, contracts and borders before the final amount is decided. The hidden rule is simple. The tax system is strongest against money that cannot move. And once money can move, the people who understand the map gain an advantage over the people stuck on the conveyor belt. In the next video, we will see what happens after the tax has been paid, because Britain does not only collect money differently, it rewards money differently too.